Welcome to this deep dive. Every investor dreams of that one home run, a stock that returns 100 times your initial investment. In his book 100 Baggers, Christopher Mayer studied 365 of these rare winners. But let's be real. Theory is great, but how do you actually find these companies today among more than 20,000 listed stocks? Today, we aren't making vague promises. I'm going to show you, step by step, how I've translated the quantitative filters from Mayer's research into a functional screener in ChartMill. We are going hunting for the financial DNA of tomorrow's winners. Before we touch the buttons, you need to understand what drives a 100 bagger. It's almost never just about earnings. It's what I call the twin engine effect. Cylinder 1 is fundamental earnings growth. Cylinder 2 is multiple expansion, the market discovering the stock and becoming willing to pay much more for every dollar of profit. When both engines fire simultaneously, you get a massive lever on your returns. That is where the magic happens. Step 1. We are looking for small companies or acorns. Mayer noted that most 100 baggers started small. He used a $1 billion limit back in 2015. Due to inflation and overall market growth, we're bumping that up to a maximum of $2 billion. Why? Because a $50 billion company simply can't go 100 times anymore without becoming the size of the entire global economy. We need runway. Step 2. The quality engine. This is the most important filter of the entire session. Mayer discovered that 100 baggers are extremely profitable. We look at the 5-year average of return on equity and return on invested capital. We want at least 15%, ideally 20% or more. Why use an average? Because one good year could be a fluke. We want companies that can fund their own growth without constantly begging the bank or diluting shareholders with new stock. This proves a real competitive advantage, a moat. Step 3. Fuel for the engine. Without growth, the engine stalls. We look for companies that have increased their sales by at least 10% annually over the last 5 years. Important, we are looking at revenue, not just profit. In the early stages of a 100 bagger, profits are often reinvested immediately to capture market share. Revenue growth is the evidence that the product or service is actually in demand. Step 4. Skin in the game and margins. Next, we look at the human factor. We want owner-operators, people like Jeff Bezos or Elon Musk in their early days. We filter for insider ownership of at least 10%. When the CEO is a major shareholder, they think in decades, not quarters. Additionally, we add a gross margin of at least 30%. This is indirect proof that the company has pricing power and isn't being crushed by competitors on price. Step 5. Plugging the leaks. Now, this might surprise some income investors, but for a 100 bagger, a dividend is actually a leak in the growth engine. If a company has a high return on invested capital of 15% or 20%, we don't want them sending cash to us. We want them to reinvest every single dollar back into that high return business. That's why we filter for no or very low dividends, under 1%. We want a compounding machine, not a yield play. Now look at the results. Don't be alarmed if only a handful of companies remain. Many investors make the mistake of adding a valuation filter here, like a low PEG ratio. Don't do it. Quality is almost never cheap. If I applied a PEG filter of 1.0 here, I'd likely be left with nothing. You must be willing to pay a fair price for an extraordinary company. Is your list completely empty? Then expand your market cap to $3 billion or even $5 billion, but never touch the quality filters like return on invested capital or growth. Quality is non-negotiable, or relax the insider ownership check. Data on insider holdings can often be noisy or outdated in automated databases. It is better to verify this manually in the company's latest proxy statement or annual report for your final candidates. If that still yields no or very few results, allow a modest dividend, less than 2%, provided that the payout ratio remains low. Some elite compounders pay a limited dividend to attract a broader base of institutional investors. And there you have it. The screener has done the heavy lifting. It has filtered out 99% of the noise. Now it's up to you to dive into the annual reports. Look for the moat and the character of the CEO. And once you find that winner, apply the coffee can method. Buy the stock, put it in a metaphorical vault, and don't look at it for 10 years. The biggest gains aren't made in the trading, they are made in the waiting. You can find this exact filter as a trading idea in ChartMill. Thanks for watching, and good luck with your research.